All right, welcome everyone. So today I'm very excited to welcome Dr. Rachel Friedman to our workshop. She is currently an assistant professor at the Bookman Faculty of Law in Tel Aviv, and before she took that position, she was at Harvard, where she did a PhD and a JD. And so, just personally, I'm a huge fan of her book. I think that it sits at this extremely narrow intersection of insurance, political theory, and maybe law, and there aren't many people that sit there. And a book that is this insightful and in that area comes out maybe once every 10 years. And this is as good as any that I've ever seen in this area. And so I'm personally really glad to have her. And if you haven't read the book in full, I would encourage you to buy it and check it out. Before I hand it off to her to present a quick teaser on our next presentation. So in 2 weeks, we'll have Heather Field from UC Law in San Francisco presenting a very interesting paper on tax insurance, which is to say just insurance against tax liability and the way that type of insurance can act as a sort of private enforcer of the tax code. So stay tuned for that one. And with that, I'll hand it over to Rachel.
Okay, well, thank you so much for that very kind introduction, and nice to see you all. Thanks for coming today. I'm very excited and grateful to be here, and I'm grateful to Professors Panton and Siegelman for the invitation. I'm a political theorist and legal scholar who studies the normative theory, law, and comparative policy of the welfare state, among other things. And so my talk might be a bit different from others in this series in that I'm going to discuss the history and theory of social insurance, which is, of course, a major pillar of the modern welfare state. By the term social insurance, I'll turn to my first slide. I mean the provision of event-conditioned benefits through a publicly orchestrated system of contributions and distribution. The rubric includes pensions, unemployment, disability coverage, health insurance, parental leave policies, and more. The basic logic supporting these policies is that people who are in a good state, healthy, employed, earning a reasonable wage, will generally wish to protect themselves against the risk of falling into a bad state, such as illness, unemployment, or poverty. To secure this protection, they pay a premium that's correlated in some way to their age and situation into a designated fund, which is typically invested and portions of it redistributed to anyone who encounters the eventuality in question. Social insurance is a close relation of private insurance, and indeed, as I argue in my book, emerged from it. But social insurance differs from private insurance in that the state can compel participation, which allows for a degree of redistribution between risk and income categories that we don't often see in private insurance schemes. Social insurance is also distinct in the risks that it covers, which historically have been tied to lost earnings capacity. Think of work accidents or disability, illness, the death of a breadwinner, unemployment, and old age. These risks are typically seen as beyond the individual's control or as generating costs that the individual should not have to bear alone. Often, there are also risks for which private insurance markets cannot or do not provide adequate or accessible coverage. One of the central claims of my book is that private and social insurance both reflect the same fundamental duality, which they inherited from the concept of probability itself. As Ian Hacking has famously argued, the concept of probability is Janus-faced in that it has two enduring aspects. One, the epistemic, concerns the degree of belief warranted by a given body of evidence. The other, which Hacking calls the aleatory, but which has also been called the objective or ontic, concerns the laws of chance processes or the tendency of some events to produce stable relative frequencies over the course of a large number of trials. A probability value can therefore refer either to my own estimate of the chances that some event will occur, say that I will lose my job, get sick, or encounter an accident, or it can refer to the frequency with which that event occurs in a series of similar trials, say among women my age with similar backgrounds, capabilities, or habits. The significance of this duality, I argue, is that the theory of probability offers two different types of practical counsel. First, it's a tool for guiding individual judgments in the face of uncertain outcomes. My assessment of how likely an event is will influence how I choose to act with regard to it, including whether and how much I seek to protect myself against its costs. Second, probability offers a measurement of equality among those who face the same odds of an uncertain outcome. The process of deriving a probability value rests on classifying some events as equally likely to occur. This, in turn, has important implications for cooperative action and the distribution of resources when an event takes place. Both phases of probability, I argue, find expression in insurance. Insurance was the first practice to explicitly involve the exchange of risk in the context of maritime insurance, and then to use statistical probabilities in mutual life insurance. Insurance is simultaneously a prudent means of self-protection and a reciprocal arrangement that by collecting premiums from a group of similarly situated participants can fairly distribute resources among them. I argue that this dual character is a key to understanding the political salience and staying power of insurance in modern liberal democracies. In the chapter of the book that was circulated for today, I discussed the moment at which prominent thinkers began to realize that the same ideas and techniques behind private mutual insurance could be applied at the national level to promote security, independence, and reciprocal self-help across society as a whole. This, I contend, was the intellectual inception of the modern welfare state. The subsequent chapters go on to trace how changing accounts of probability found expression in or affinity with normative thinking about poverty relief, distributive justice, and social welfare. With this background in place, I'd like to do three things in my talk today. First, I'll share with you some insights from my research into the historical development of social insurance, focusing on that seminal moment in the late 18th century at which the idea first gained traction. Second, based on these insights, I'd like to contrast the normative principles animating social insurance with those that support some other welfare policies, including the idea of a universal basic income. Finally, I'll reflect on the contemporary political economy of social insurance and its possible place in the future of the welfare state. So, as I just mentioned, the period leading up to and including the French Revolution was the moment at which, the intellectual groundwork for social insurance and therefore the modern welfare state was laid. The developments that I traced took place in Great Britain and France and were driven by a group of thinkers deeply schooled in mathematical and scientific advancements and actively involved in political life. During the period leading up to this time, the enclosure of farmlands and the rise of commercial society had rendered the working population increasingly reliant on wage labor and therefore vulnerable to various disruptions in their livelihoods. The thinkers that I consider were concerned about the implications of these realities not only for the poor, but also for society as a whole, since growing inequality and dependence threatened to impede political liberty and social progress more broadly. Their solution to these problems, namely to use the power of the state to promote mutual insurance in the form of annuities, pensions for widows and orphans, and more, grew out of developments in mathematical probability theory and their demonstrated success in commercial life insurance. Such insurance had shown its potential thanks in large part to England's Equitable Life Insurance Society, which was founded in 1762 by mathematician James Dodson, a student of the probabilist Abraham de Moivre. Dodson had been denied admission to another insurance society on the ground that, over the age of 45, he was too old for coverage. He therefore set out to establish a life insurance association that would grade premiums on the basis of age and therefore be able to accept older customers without jeopardizing its viability. The result was a remarkably successful endeavor that sparked imitators elsewhere and served as a model for many social insurance advocates. Such insurance rested on what is today denoted as risk pooling. That is, the idea that as the insurer takes on more and more risks of a similar nature, his side of the transaction looks less and less like a wager, while the insured's payment decreases to reach her own mathematical expectation based on the average risk of her class. In principle, the virtue of pooling risks in this way is that it aligns what the insurance association must collect from each member with the amount each should pay according to her own risk assessment. At the limit, insurance is no longer a gamble or even a risky venture, but a prudent and fair arrangement for the mutual sharing of burdens. This image of insurance as a reliable and fair way to distribute the costs of uncertainty across a group paved the way for the idea that it could be used on a political scale to both individual and public benefit. This vision was enabled by key mathematical developments, most notably a technique known as inverse probability, which allowed for calculating the likelihood of an unknown composition or state of the world given the observed outcomes of events. Inverse probability is a form of induction, that is, of inferring from a number of cases of which something is true that the same is true for the entire class, and the foundation of what's now known as statistical induction. For its pioneers and early adopters, including Richard Price, Pierre-Simon Laplace, and Condorcet, inverse probability promised to enable the use of probability calculations in a wide range of matters of civic concern, not least of all, social protection through insurance. At this time, insurance advocates envisioned two possible routes for providing coverage on a national scale. The first was to introduce actuarial reforms into the box clubs or friendly societies, which were voluntary organizations that had long provided mutual aid to members of the working classes. The second was to apply the same principles to insurance schemes orchestrated by the state. While neither approach envisioned compulsory nationwide coverage on the scale that we recognize today, both called on the power of government to facilitate the pooling of risks and therefore encourage mutual support among those vulnerable to disruption and poverty. For example, the mathematician and political thinker Richard Price supported both the legislative reform of friendly societies and public annuity schemes, both of which he thought could promote a form of property ownership and therefore independence among those lacking property and land. Price's influential reference work, Observations on Reversionary Payments, first published in 1771, was intended primarily to improve the middle-class life insurance schemes that had proliferated in the latter half of the 18th century, many of which were poorly managed and resulted in financial losses for their members. Yet he soon joined the cause of promoting actuarial insurance for the working class and poor as well, through the movement to reform friendly societies. These societies had first emerged as local groups that brought together neighbors or members of the same trade for socializing and the pledge of assistance in the case of need. From their inception, the British societies were voluntary, and they remained largely local both in scale and character through the early 1800s. Formed among men who knew each other or were in some sense part of the same community, the friendlies usually charged equal fees and paid a flat benefit to any member who encountered a situation of need, most notably sickness, death of the breadwinner, including the lack of burial expenses, and old age. They also used a portion of the dues collected for club meetings, which members saw as central to the overall benefits of belonging. Price proposed a model for financing friendly society benefits that, as Penelope Ismay has shown, had a powerful influence on contemporary discourse about poverty relief. In 1772, he lent his support to a proposal by mathematician and social reformer Baron Francis de Maseras that would have given workers in manufacturing areas the chance to buy annuities through their parishes, to be paid out of the poor rates of the parishes themselves. Price published selections from Maseras's work as a supplement to the second edition of his reversionary payments, where he argued that with some modifications, the proposal would not only promote industry among workers, but also, quote, ease parishes of a considerable part of their burdens, end quote, in providing poor relief. As part of his advocacy, Price supplied the tables from which annuity prices were to be calculated. Although Maseras's proposal, as well as the subsequent one of 1789, met with a defeat in the House of Lords, a successful Reform Act of 1793 made Price's calculations the standard reference for friendly society contributions for the 3 succeeding decades. Following Maseras's proposal, English clergyman John Ackland also relied on Price's calculations to propose another plan for national-level mutual insurance. The plan, published in 1786, would have created a single compulsory mutual society for the entire polity. Learning from the failure of an earlier scheme, Ackland recommended that participation be mandatory for all, with the exception of those who possessed landed property. The effect of such a plan would thus be to, quote, render the poor to a great degree independent of public charity by erecting them into such an associated insurance office as may secure to them a comfortable provision against all the accidents to which their station is liable, end quote. Price supported Ackland's plan as well, writing in a letter to the author that such a program would do a great amount of good by offering the most, quote, agreeable and useful relief to the poor, end quote. Price went as far as to say that the principle on which the plan was founded, the principle of mutual insurance, should be universally approved, since nothing is more reasonable or equitable than that the poor should put aside a small savings from their wages to support themselves in the event of sickness, accident, and old age. The fact that such societies existed in great numbers proved, he argued, that the principle already drew widespread support. Although Ackland's plan was never realized, subsequent reforms did grant important legal rights to members of friendly societies. One of these, known as the First Friendly Society Act, or Rose Act, freed members from some of the strictures of the laws of settlement, which forced migrants to a parish to carry a certificate attesting that they wouldn't become a public burden. By recognizing that friendly society members were by definition hardworking and industrious, the law made it easier for them to gain settlement in their destination parishes. According to Price, these efforts promised not only to help relieve poverty, but also to promote the foundations of civil liberty. Price stressed that liberty requires not merely the ability to do what one chooses, but also secure possession of life and property, without which one cannot be one's own legislator. Price was therefore keenly aware of the threat posed by severe inequality of property ownership. With too much property, some individuals co-opt power and use it for their own interests. With too little, they fall into dependence and are poorly suited for citizenship. In this light, Price's advocacy of actuarial life insurance and friendly society reform, including publicly supported mutual schemes, entail a powerful justification for what would eventually be known as social insurance. This justification rests on the secure and property-like character of insurance benefits, obtained or earned through probabilistically determined premiums and guaranteed through prudent financial management. It further extols the ability of such benefits to protect against financial devastation without discouraging personal effort, and thus to promote the reciprocal benefit of all participants to the agreement. In this respect, Price was a key intellectual progenitor of the modern welfare state, the aim of which is not merely to alleviate poverty, although that's a very important aim, but also to promote equal freedom and secure self-government for all. As mentioned earlier, Richard Price was part of a generation of thinkers who together laid the intellectual groundwork for the emergence of social insurance schemes in the latter part of the 19th century. I've already mentioned Maseres's plan, which claimed that giving workers the opportunity to plan for their own futures by purchasing annuities would encourage them to become, quote, more sober and virtuous in their ordinary course of life, end quote, and in this way increase the wealth of the kingdom as a whole. Maseres's proposal described the process by which poor residents would purchase annuities and mandated that a sealed and signed parchment be delivered as the proof of their right to future payments, in other words, a sort of property right. He too thus regarded protection as a form of property earned through contribution and guaranteed with the force of law. He also emphasized that the absence of such insurance would render the unfortunate a double burden, since the public would not only lose the benefit of their labor, but also be forced to take on the expense of supporting them. Mutual insurance thus promised to align the personal interest of individual workers in security and self-legislation with the public interest in avoiding their indefinite maintenance. In 1787, Price's fellow radical dissenter Joseph Priestley praised Maseres's plan and voiced support for a similar one that would encourage forward-looking self-protection among the poor. Like Price, Priestley's support for such mutual insurance reflected an underlying commitment to property liberty. He introduced his plan with a criticism of existing poor relief that, by simply granting a legal right to aid, had encouraged dependence on the parishes rather than self-improvement. His proposal would use the poor's own efforts to their advantage, thereby encouraging, quote, a sense of independence and of dignity, end quote. The existence of the friendly societies already attested to the value of this idea, but because of their financial failures, property in them was insecure, and they hadn't realized their full potential. The state, he argued, should therefore, quote, do for these industrious poor, but what they were always attempting, but in vain, to do for themselves, end quote. Namely, provide a fund into which they could deposit their savings to support their families when no longer capable of work. Another early social insurance proposal with striking similarities to Price's came from his correspondent, the Marquis de Condorcet. In 1785, Condorcet sent his Essai sur l'application de l'analyse à la probabilité to Price, possibly in response to Price's publication of a letter from Condorcet's mentor, Turgot. The two exchanged further correspondence in 1786, in which Condorcet thanked Price for sending him an excellent work, which may have been Ackland's pamphlet from the same year. Condorcet noted that whoever had first invented friendly societies on behalf of widows and children was, quote, one of the great benefactors of humanity, end quote, who had managed to make games of chance useful. Condorcet further expressed his confidence that political arithmetic would eventually be, quote, the most useful of all the sciences, and that from which will result the greatest good for mankind in general, end quote. Condorcet's writings on social improvement stress many of the same normative arguments and practical means as Price's. In his late and unfinished The Sketch, first published in 1795, Condorcet cited Price, Priestley, and Turgot as the, quote, first and most brilliant apostles, end quote, of the new doctrine of the indefinite perfectibility of the human race. Like Price, Condorcet believed that the probability calculus would play a central role in such progress, providing the tools to improve individual reason and to rationalize political economy. To this end, he proposed 3 publicly orchestrated, actuarially informed insurance schemes that would alleviate workers' insecurity and dependence. The first would have guaranteed to the elderly a continued livelihood based on their own savings. The second proposed insurance for widows and orphans, and the third would have paid a kind of subsistence income to the young. The aim of such schemes, on Condorcet's account, was to ensure that everyone is able to, quote, manage his household, administer his affairs, and employ his labor and his faculties in freedom, end quote. Each of these thinkers thus stressed the potential of state-orchestrated mutual insurance to promote both personal liberty and a common good. In all of their proposals, one finds a commitment to forward-looking self-protection combined with mathematically informed mutualism. Thanks to the probability calculus, then, states had the tools to harmonize, in Condorcet's words, quote, the interests of each with the interests of all, end quote. I'd now like to turn to the second main objective of this talk, which will take a bit less time, which is to contrast the principles of social insurance with those of alternative social welfare policies. Clearly, as the preceding discussion shows, social insurance rests on a very different normative logic from traditional poor relief, which entailed invasive inquiries into recipients' moral character and provided only the bare minimum in an effort to deter and even penalize reliance on such aid. Advocates of social insurance, by contrast, regarded it as a way to provide aid without discouraging industry or undermining personal liberty. Social insurance also differs in principle from another policy idea that emerged at the same time and which has gained considerable traction in recent years, namely the idea of a basic income. In the late 18th century, the most prominent advocate of this idea came from another radical reformer, Thomas Paine. In his Rights of Man, issued in 2 parts in 1791 and 92, Paine proposed a series of tax-financed payments, including old age stipends, educational assistance, and maternity benefits to the poor. He argued that such support would amount to a right rather than charity and would eventually supersede the poor laws, those, quote, instruments of civil torture, end quote. Intriguingly, Paine referred to these payments as a tontine, which is a type of insurance scheme that provides greater benefits the longer one lives. Such schemes are arguably less mutualistic than the annuity and insurance plans recommended by Price and Condorcet, which were designed to provide equal benefits in exchange for equal payments. In fact, the Equitable Society redistributed excess funds equally among its shareholders. Paine also proposed to finance benefits through progressive taxation, making them available without the need for a prior payment or contribution. Paine departed even more decisively from the logic of mutual insurance in a subsequent contribution, his Agrarian Justice of 1797. Here, he proposed to create a national fund supported by an inheritance tax, out of which all citizens would receive a lump sum upon coming of age, and everyone over the age of 50 would receive annual fixed payments. Paine described these benefits as compensation for the loss of all men's natural inheritance, which, quote, has absorbed the property, following, quote, the introduction of the system of landed property, which has absorbed the property of all those whom it dispossessed without providing, as ought to have been done, an indemnification for that loss, end quote. The purpose of these payments was therefore to offer a form of redress for the suffering caused by what was essentially, in Paine's view, the theft or destruction of common property through private appropriation. It was not, as in Price's thought, to offer forward-looking mutual protection for those industrious and far-sighted enough to help themselves. Given the recent surge of interest around the world in the idea of a universal basic income, I think it's fruitful to contrast Payne's vision with the proto-social insurance proposals of Price, Priestley, Condorcet, and their contemporaries. Both visions propose to remove public aid from the logic of poor relief, with its emphasis on means testing and deterrence. Both emphasize that benefits are a legal entitlement, and in that sense, closer to a property right than the charity provided by the state. Both, therefore, represent an important step toward a vision of welfare policy as enhancing personal liberty rather than dependence on the goodwill of others. Yet examining the two proposals together also illuminates a subtle difference that's not often recalled in intellectual histories or contemporary debates. According to the proposals I discussed earlier, the independence enabling power of insurance is related not only to its status as a kind of right, but also to its mutual or reciprocal character. That is, insurance promised to promote liberty both because it would be reliably granted and because by securing themselves, citizens would simultaneously do the same for others. In other words, social insurance promised both a form of personal security and generalized reciprocity or solidarity, a good that is spread or shared across all members of the group. It's beyond the scope of my talk today to consider all of the comparative merits of contributory social insurance and an unconditional basic income, but my historical inquiry suggests that there are important differences in their normative justifications. Insurance advocates praise such practices for reconciling the individual's economic interest with the community's need to sustain itself, both financially and ethically, through ongoing reciprocal relations. By contrast, the normative logic of a basic income is not explicitly or necessarily tied to a principle of reciprocity in the same way. Historically, it's safe to say that the insurance model carried the day. While the reform ideas of Price and Condorcet's generation were no longer influential by the mid-19th century, when the practice of social insurance finally got off the ground, arguments for state-sponsored protection against economic risks continued to rely on insurance as their organizing principle and to distinguish clearly between insurance benefits and poor relief. For example, as François Yuval has claimed, in 1850, the French Legislative Assembly arguably inaugurated social insurance there by creating a national pension fund to channel and guarantee workers' savings. Bismarck's three seminal social insurance laws enacted in the 1880s took inspiration from the French precedent and established a right to benefits that was not contingent on a demonstration of need. While clearly enacted under different pressures and circumstances, these laws rested on many of the same normative principles and practical means as the proposals I just discussed. And as welfare states proliferated and expanded in the decades just before and after the Second World War, social insurance became increasingly entrenched as a policy paradigm and a main tool of welfare provision. With this in mind, I'd like to turn to the final objective of my talk, which is to suggest how my research into the history of social insurance relates to current and perhaps future welfare policy. It's well known that liberal democracies are currently in a state of significant flux. Thanks to a combination of political reforms and economic developments, we've experienced rapid structural change from industry to services, as well as the rise of a new type of politics, the politics of status defense. One manifestation of this new politics is right-wing populism, which we can understand as an attempt among the old, middle, and working classes to defend their economic positions and lifestyles against perceived threats from trade, immigration, and diversity. A parallel trend is the tendency of many well-educated elites to sort into good school districts and wealthy neighborhoods and then exclude others through restrictive zoning and building codes. In both cases, status defense creates segregation, hierarchy, and political division. In a recently published article, Harvard's Torben Iverson and I set out to understand why people turn to status defense rather than supporting broad-based social insurance and other egalitarian investment policies that could increase security and opportunity for all. We argue that when inequality rises and mobility diminishes, status defense takes over from the insurance motive and undermines social solidarity. To understand the context of this argument, it's helpful to take a brief step back in time. The universal welfare programs adopted throughout Europe in the decades after World War II set out to offer protection to the entire population from birth through old age. They included universal pensions, healthcare, child allowances, and income support, among others. In so doing, these programs extended risk pooling beyond the limited groups of workers previously covered to encompass the polity as a whole. While elements of status defense persisted in the post-war welfare state, on the whole, this iteration is seen as solidaristic in character because it included diverse populations and schemes that provided impartial and encompassing coverage to all. The programs that resulted have also proven to be quite durable. Today, according to the OECD's measure of net social spending, publicly provided social insurance accounts for between a quarter and a third of GDP in advanced democracies. Aside from path dependencies and institutional stickiness, I've argued that there's a deeper reason for this staying power, which has to do with the Janus-faced character of probability and insurance. Insurance is both a prudent response to uncertainty and a form of reciprocal aid among equals. As a result, it appeals to the two core commitments of liberal democracy. On one hand, the freedom and responsibility of the individual to pursue her own good. On the other, the basic equality of all members of the community, who cope with the same threats and vulnerabilities simply as a result of being human. At the same time, today's welfare states face significant new challenges, including population aging, changing employment patterns, capital mobility, and the ICT revolution, to name a few. The first three of these phenomena make social insurance more difficult to finance, while the last calls its political viability into question. The reason is that big data is facilitating the expansion of private insurance coverage, encouraging purchasers to share information with insurers, and allowing insurers to offer premiums that more closely track differentiated risks. Private insurance thus offers a substitute for social insurance, at least for those with lower risks or greater means, and may threaten political support for public systems. Add to this the pronounced disparities between beneficiaries and those left behind in the new global economy, and the solidaristic welfare state appears to be under significant threat. In our article, Professor Iverson and I model individual support for social insurance in these conditions. We conclude that the key to generating and sustaining such support is to ensure that both the upsides and the downsides of change are evenly distributed across the population. The argument rests on the following insights. For the individual, belonging to a group whose members face or believe they face similar risks offers a reason to support a mutual insurance scheme that will protect everyone on equal terms. But how does the individual know that she's part of such a group? Philosophical treatments of the reference class problem teach us that every event can be classified in multiple ways. This creates a political difficulty because individuals who believe they belong to a lower risk class may not support social insurance that groups them with those at higher risk. We argue that there are two scenarios in which people are likely to see themselves as facing similar exposure to everyone else in the political community. The first is under conditions of high uncertainty and low information, when it's difficult or impossible to accurately assess one's own risks. Think, for example, of the people behind Rawls's veil of ignorance, who don't know anything about themselves or where they're likely to end up in the future. In decision theory, this is known as decision-making under uncertainty, and there's no widely accepted view of how people make choices in this case. The second scenario is when overall life chances are in fact relatively equal. We model this situation using John Harsanyi's objectivist interpretation of Bayesian probability. On this account, people begin with their own prior probabilities and update those probabilities as they acquire more information from their experiences in the world. When their initial state is one of relatively equal life prospects, they'll adopt the population average as their prior and then update their estimates based on the state of equality they encounter. By contrast, when their initial state is one of high stratification, they'll link their priors to observable differences in income, status, and other group markers, and subsequent updating will only reinforce those differences. In this way, we can identify feedback effects between conditions of equal opportunity and social integration on one hand, and support for policies that sustain those conditions on the other. If the pool is initially broadly defined and people's priors conform to a common risk, that is, if their prospects are roughly equal, then the path of subsequent updating will be different than if risks are differentiated across many narrower pools. Universal coverage further helps to preserve broad risk pooling by maintaining people's incomes and status, so that they don't need to take lower paying jobs or switch neighborhoods during periods of disruption. Coverage thereby preserves equality and makes it more likely that subjective assessments of risk will converge in the face of Bayesian updating. In this way, as scholars such as Andrea Campbell and Paul Pearson have shown in different contexts, the structure of social protection shapes policy preferences in ways that in turn reinforce that structure. For our purposes today, the point I wish to stress is that this argument confirms features of social insurance that neither means-tested nor unconditional income programs display. Unlike means-tested benefits, social insurance can be universal in scope, covering everyone on equal terms. As such, it not only promotes material equality, but also reflects a form of relational equality between citizens who protect one another against risks they face in common. Unlike a basic income, social insurance requires citizens to be active both in contributing to their own security and in sustaining the safety net through economic and political participation. In these respects, the fundamental duality of probability continues to find expression. On one side, in the individual's pursuit of opportunity and self-protection, on the other, in the community's commitment to equality and providing the basic conditions of a decent life for all. Understood in its broadest sense, then, social insurance will likely remain a pillar of advanced welfare states so long as these core normative commitments persist. With that, I'll conclude, and I look forward to your questions and comments.
Thank you so much, Rachel. I mean, there's a ton there, and so I'll take the first question. But if anyone else would like to get on the queue, you can either do the little raise hand thing in WebEx or send the chat either to the group or to me individually. To me, just to take a step back from the work in general, the most interesting and helpful takeaway from this is the kind of Janus-based concept of probabilistic justice that runs throughout the book. And I think that in a certain sense, I want to just dwell on that a little bit because as with anything that's sort of inherently contradictory, it can be a little hard to wrap one's head around at times. And so one way of asking about how here's a question about how you think about that. So it seems like one could argue that what you're describing as the effects of insurance, the way that insurance has both a sort of distributive quality and an integrative quality, and that those being the sort of the two sides of the face, that's really what you're really describing is just markets. And so that like the market transactions are distributive in the kind of obvious sense, but they're also integrative in the kind of du commerce theory sense, and that like the modern state relies on markets to kind of bring people together, whereas they might otherwise fly apart, if not at the national level, then at the international level. And so, and I asked this partly because I know that I took it from the book that you kind of don't lean on the distinction that Joseph Heath makes between like risk pooling and risk exchange to distinguish insurance from market exchange the way he does. So in terms of just trying to get a clearer sense of what you take insurance to be and what you take this essential quality of like probabilistic justice to be, I thought it might be helpful to press on that to see how you distinguish it from markets generally.
Okay, great. Yeah, thank you. So I think that there is a sense in which insurance, as I see insurance, it's sort of the flip side of the market, right? There's clearly a logic. So the point that I'm trying to make with the duality or the Janus-based character of insurance is to say that basically it has within it these two, and I don't think they're contradictory. I think that they are potentially in tension, they're distinct. But what's been so interesting about studying the evolution of thinking about insurance is these various efforts to align the two sides and how that takes different forms at different times. So the two faces can point in different directions, and they do point in different directions. The one is the more obviously sort of market logic based face, which is, as participants in a commercial society, we seek and pursue our own good using this form of probabilistic instrumental reason. On the other hand, as participants in these commercial societies and political communities, we seek together through cooperative action forms of protection that will limit the downsides of that market participation. So in that sense, I see insurance, yes, as integral with markets, but distinct in that it's serving a function that is reactive to the logic of the market. And you see that also, I think, in accounts of insurance today and efforts to bring social insurance up to date in light of new social risks, right? There's a sense in which insurance is the flip side of capitalism's creative destruction. And so we need it for that purpose. And as for the two sides, as I mentioned, I mean, I think what's really so fascinating about the period that I discuss in this chapter is how confident these thinkers were that the two sides were in fact congruent, that the individual logic of pursuing one's own economic good would perfectly align with the community's need for reciprocal self-protection. And this rested on mathematical developments, and in some ways, I argue in the next chapter, these thinkers sort of fudged some of the difficulties that their vision involved. But I think the effort, at least, to align the two sides is really at the heart of a lot of thinking about social insurance over the course of these centuries that it evolved.
Great. I have a zillion other questions, but so I'll, Kristen Hand, do you want to go?
Hi, yes. Sorry, can you hear me?
Hi, yes.
Hi. Thank you. That was a super interesting and informative discussion. I was just curious because throughout the chapter, there's kind of discussion about the moral undertones of like how this all came about and everything like that. So I was just curious how you kind of reconcile that with like a world today where there's so much, you know, where commercial insurance is so dominant, and whether you still kind of see those underpinnings and that part of the influence now.
Yeah, that's a great question. Thank you. So I think the story that I tell in terms of the moral components of insurance and thinking about insurance really goes back to the very, very beginning of probability theory. And that's sort of the subject of the first chapter, how even in thinking about games of chance and all aleatory contracts, there was sort of built into it this effort to make contracts fair by equalizing the two parties in terms of their expectations. And that was really the impetus behind a lot of probabilistic thinking from the 17th century onward. And so that, I think, never went away. I think and that's really the side of insurance and the side of probability that focuses on equality and an understanding of equality and the principle of probabilistic justice, meaning that distributive entitlements rest on an understanding of equality in the face of chance. So that, I think, has always been an undertone of mathematical probability and thinking about insurance specifically. Part of what I tried to do at the last part of the talk and what I tried to do in this paper with Torben Iversen is to see how, precisely in response to your question, the concerns that it involves, how that logic might be extended today, given the very specific circumstances that we find ourselves under. On one hand, as I mentioned, these programs have remained. So the US is an outlier in terms of many things, but in terms of its social insurance system, in terms of the extent of redistribution that happens here, et cetera. But European countries and advanced welfare states continue to have very robust social insurance programs. They come under threat from a variety of forces, political forces. We see welfare chauvinism, which sort of tries to push on welfare programs from the more populist direction. And of course, we also see the incursion of private insurance, which poses a major threat to the political support for public systems. But I think the key is that if you understand what I think we identify as the core components of public support for social insurance, namely a sense of uncertainty, which motivates people to seek to protect themselves against the downsides, and some understanding of equality in the face of risk. then I think there are pathways to go in the more solidaristic direction. But essentially the argument of the paper is that we're at a critical juncture and the outcome is undetermined, because we could go in the direction of increasing risk segregation. All of the forces are in place to go in that direction. And so it will take a significant amount of political entrepreneurship and intervention to go in the more solidaristic direction instead.
Thank you.
Great. So queue is open. Tucker, you want to ask your question?
Yeah, sure. Can you hear me? I think so.
Yes.
Hi, just first of all, thank you for being here today. So you kind of answered a lot of I had a much longer question, but kind of answered a little bit of it. So number one, I kind of did my own research on after reading this, and I learned that, friendly societies do exist today. And I was just wondering why you think they're not more common today. And kind of as a second part, modern insurance, welfare, government aid, do you think those are the next step in insurance evolution, or do you think we're kind of backtracking, in your opinion?
Great, thank you. So it's a very interesting question, friendly societies, what happened to them, why they didn't end up being a model for social provision through the 19th century. And essentially there are a lot of different arguments for why they failed. I'm a little bit more sympathetic to them than some scholars who essentially argue that they really could not have possibly expanded to cover enough of the population on a basis that would be financially sustainable. So I think a big part of the reason has to do with the need to scale these programs in order to redistribute risks in a way that is sustainable financially. And really, at a certain point, the state is best suited to do that. I mean, we do see in the form of unions, right? There are limited areas in which more localized bodies continue to provide some form of social insurance. So the Ghent system is one example, and unions might be uniquely well suited to provide on insurance coverage. And so there are ways to do that, but essentially because I think the answer to your question about why friendly societies are not more popular or more common today is because they just couldn't provide the function that social insurance provides in terms of really pooling risks on a very substantial scale. As for the second question, so maybe I'll ask you to clarify what you meant in terms of the alternatives that you described. So insurance versus more of a residual type of welfare state.
Yeah, I guess I just mean, what do you see as the next step, or do you see a next step or an end goal, honestly?
Right. So I think and this gets back to the previous question, that the path in our contemporary politics, right, we see very clearly that we could go in more than one direction. And the argument of this paper with Torben Iversen is to say, we'll all probably be better off if we can act cooperatively to sustain these more universal insurance type programs, at least with regard to certain core risks. And I think that this has been that was one of the most interesting insights for me. That in full disclosure, I started writing this book with no real opinion about social insurance. I just kind of wanted to understand what it was. And it seemed, on one hand, to be a bit of a fudge, sort of, okay, but so we know what insurance is, and we know what social assistance is, and social insurance is kind of in the middle. And I think Milton Friedman used the term that it falls between the stools, and that it's sort of a very clever political ploy, but what is it really? Is it actually a coherent concept in itself, or is it just a kind of a clever marketing strategy to allow the state to redistribute our resources. And what I found in doing this research was that actually it's very sophisticated technology in many ways, and part of the sophistication lies in its flexibility. So not only over the course of its history do you see it trying to reconcile the two faces of probability in different ways, but also you see it evolving to meet new social risks and new needs. And so I tend to think of social insurance as this very plastic technology, and is very valuable in that respect. So that's why I would say we shouldn't give up on it. It has more life to live. It has more evolution to do. So that, I think, would be my, without trying to predict anything, that would be my answer to that question.
So I'll just jump in on that point. So it seems that, you know, you could argue that the flexibility of it and the kind of multiple faces of it is like both a feature and a bug of social insurance, in the sense that, like, it does allow it to be quite plastic over time with regard to, you know, different risks and different sort of technologies, right? Like different developments in probability theory and stuff like that. But it also seems to be that, like, the moment you get the political buy-in to enact a policy that is sort of on the like solidaristic side of insurance, it immediately becomes exposed to the counter argument that no, that's not insurance. Like, proper insurance at a sort of like ontological level is necessarily like structured with actuarially fair pricing and so it makes any kind of like solidaristic form of public insurance inherently unstable, and maybe that's a downside to it. I don't know, but I'd be interested in your thoughts.
Right. I mean, I came to see it as a virtue, and I mean, and I think just as a matter of observation, these policies, for better and for worse, tend to be pretty stable, right? We see that at a certain point, they might actually stop being as necessary as they once were. We see that they might at some point be a drain on economic resources and economic growth, right? Peter Lindert has made the argument that there's been mission creep with regard to welfare states since, you know, in the last several decades, where increasingly pensions are taking up a huge portion of public spending, and we're going to see it increasingly difficult to finance them going forward. So I don't know that stability is necessarily always a good thing with regard to social insurance programs, but they do seem to have, again, for better and for worse, a lot of staying power. And part of this has to do with the feedback effects, that once a policy is in place, once an institution is in place, it tends to create the constituency for its continued existence. And we see that with regard to welfare programs. So in that regard, I worry less about social insurance than I do. And actually, I would say conceptually, there's a lot of flexibility. Politically, it can be very difficult to evolve these policies in ways that might actually better serve populations.
Great. So I think we have time for one more question. Allison, you want to go?
Hi, can you hear me?
Yes.
Thank you so much. This has been a super interesting conversation. And a question I have is, when you look back at the roots of social insurance, how much of it was based on kind of shared insecurity, where there was kind of a more traditional family model? And I ask this in part because we're seeing a return in the discourse to thinking about traditional roles. And could that kind of turn to conservatism in terms of family structure be something that goes hand in hand with a rebirth of kind of belief in social insurance?
Very interesting. So I think that there is a deep connection there, and that's another point that we do make, that Professor Iverson and I make in this article, that in a sense the turn to family and community and also nation that we see in some contemporary political movements speaks to some of the same drives that motivate the turn to social insurance. There's an instinct to sort of protect what you have, to find security, to find status, to find meaning in securing those things. But I think at a certain point, they are, at least in its more solidaristic form, social insurance is a significant expansion of whatever it is that the family can do. So they have to be, and similarly with the mutual societies, the normative logics are very different. It's not at all to say that they're mutually exclusive, but I do think it's important to distinguish. And this gets back to the question of the friendlies and why they weren't able to be as prominent as they once were, because when we look to social insurance, we are really looking to something that is scalable, to the state's capacity to pool all of our risks in a way that's likely to increase all of our security. And, you know, as much as some of the impulses, maybe psychological impulses involved in the turn to family and community are similar, in terms of their ultimate expressions, they go in very, very different directions. All that being said, I mean, one of the points that we make in this article is that there is, you know, if one cares about one's family, then there is a good reason to support policies that are going to intergenerationally pool and shift risks. So there are overlaps there, and if one cares about one's elders, one's parents, et cetera, right, you might want to have policies in place that are going to allow them to get nursing care and sustain themselves throughout their retirement. But in terms of the scale and also in terms of what we're looking for these institutions to do, I would say the logics are very different. I hope that answered the question. If not, feel free to follow up.
Yeah, that's great. Thank you.
Okay.
Okay, great. Well, Rachel, thank you so much for joining us, especially what I realize is probably a very late hour where you are, and so we're grateful for your time and for sharing your fascinating work with us, and we hope to see you back here at another one of these sometime soon.
That sounds great.
And so with that, I'll see hopefully a lot of you again in 2 weeks.
Thank you so much for having me, and thank you for the excellent questions. Really enjoyed it. Bye, good night.